If you're an investor, you need to be prepared for inflation, or you might wind up kissing your assets goodbye. When inflation is running hot, the economy has to be slowed down, creating a field of landmines for investors to tiptoe through. There are a few critical concepts that every investor needs to know, and if you do, you should be able to sidestep the effects of inflation and you may actually make some money. I'm going to tell you about these important concepts and how to take action coming up. Welcome to Hoskins Research. If you're new to the channel, welcome and thanks for clicking. This is a place where we discuss financial topics in depth to help you become richer and smarter as you watch. So how did we get here? I'm talking about the economy. Inflation is going wild, prices of everyday goods are skyrocketing. We can barely get in and out of the produce section at the grocery store for under $50. And believe it or not, this affects the stock market in a major way. We can't afford not to pay attention to this as investors, as our money could soon be in danger in this environment. So let's talk about how to protect our assets from the ill effects of inflation. We pretty much always have some amount of inflation. However, sometimes it's higher than normal due to the economy having cycles. These cycles can last several years or even decades, and it's really hard to know where we are or exactly where we're headed. One decent indicator that we could look at is inflation. High inflation is usually a pretty telling sign that we're near the peak of an economic expansion cycle. And during this phase, you might hear people saying things like, the economy is running hot, or prices are soaring. So how does the economy get to a point like that? Well, it's usually the result of years of low interest rates and increasing money supply. This is referred to as expansionary monetary policy, but you might hear the terms stimulative or relaxed, loose, inflationary as well. This type of monetary policy does exactly what it sounds like. It helps expand the economy. When money supply is high, of course, there's more money to go around. And when interest rates are low, it's cheaper and easier to borrow money and buy stuff. This is the fun, woohoo kind of economy where more credit is being extended, spending is high, and prices are going up. Everything is awesome. But as they say, there can be too much of a good thing. Credit and prices eventually get overextended, and the economy overheats, which brings us to the next part of the cycle that you're not going to like. The economic phases after inflation can be pretty gross. Let's dive into how inflation gets reined in so we can know how to invest our money without getting torched. When prices are flying and the economy overheats, it needs to be cooled down, primarily by, you guessed it, the Federal Reserve. The Fed will raise interest rates in order to slow down borrowing and spending in general, thus combating inflation. It may pique your interest to know that rising interest rates have an actual mathematical effect on stock prices. Let me explain. You see, there's this thing called time value of money, and it basically says that a dollar today is more valuable than a dollar tomorrow. And you may be thinking, duh, I already know that, my brain isn't made of pudding. Of course not, but hang on. The time value of money has a serious impact on our investment strategy, especially in a changing interest rate environment. Let's boil this down. A stock's price is just the sum of all its discounted future earnings. And earnings further in the future have to be discounted more because there's more uncertainty. You discount at the risk-free rate, which is usually set to the 10-year Treasury bill, because that's the return that you get without taking any risk at all. When the Fed raises interest rates, you have to discount those future earnings of a stock more because the risk-free rate is higher, and you'd need a higher potential return to take that risk. So anyway, a stock with most of its earnings expected further in the future, i.e. growth stocks, should be discounted more than other stocks, bringing those prices lower. Mathematically speaking, when interest rates go up, growth stock valuations need to come down more than the average stock. To make matters worse for investors, the Fed also decreases the money supply to slow down the economy. It does this by selling bonds and slowing the printing of money. And these actions result in less overall liquidity in the market, making it really challenging for buying and prices to remain high. Now that's a serious buzzkill, but cheer up because we're about to lay out our investment strategy for this kind of situation. When the economy is slowing down, risk-free rates are rising, and people are tightening the old belt when it comes to budgeting, we investors need to be looking for companies that make products that people have to continue to buy. Ideally, these companies we're looking for will have pricing power, which is to say that they can raise their prices and people will still buy their products, helping the company maintain its profit margins. For example, if toilet paper goes from $10 to $17, we're still going to buy it without thinking twice. Now, to be clear, I'm not advocating hoarding toilet paper as an actual investment plan, but just know that the demand for those types of products will never be wiped out. On the other hand, if the cost of a Hawaii vacation goes from $3,000 to $5,000, tell the kids they might be staying at home this summer. With that example in mind, companies in industries like consumer staples and healthcare are a good place to start looking, and they make products that most people need even during an economic slowdown. Gross margin is a good fundamental metric to look at within these companies, especially when budgets are tight. A high quality company will generally have a higher and/or more stable gross margin than its peers. Remember, the gross margin is the good margin. Another metric that we should be considering is the price to earnings ratio, and a low PE ratio indicates a low valuation compared to the company's earnings. So like any investment, we have to balance quality with valuation. Companies that make essential products, have pricing power, good margins, and reasonable valuations should be good investment ideas in a rising rate environment. That's not to say that we can't invest in growth companies, of course, but tightening financial markets generally aren't the greatest setup for an ultra aggressive investment until prices come down a little bit. Now, this isn't some magic formula that's sent from above, but it's a good set of guidelines to start your research. As we figured out in this video, investing in a slowing economy is really tough, and sometimes the goal is just to not get wiped out. The price of pretty much everything, including stocks, is coming down in this type of environment, and that's the point. So it's not a bad idea to have some safer holdings like cash, which would allow you to preserve some value and then buy stocks at lower prices once they drop. Sometimes in investing, you have to just play not to lose. That's not fun, but surviving and slowly compounding will keep you moving forward in difficult investing environments. Drop a comment below about how you're positioning your portfolio to combat inflation, and let me know about what I left out of the video that should have been included. If you feel like you got a little bit smarter or richer from this video, leave a thumbs up and subscribe to keep getting smarter and richer. Thanks for watching, and I'll see you in the next video.